This is Accounting with Audra, and in this episode, number 6 in Accounting Basics, I will explain how companies journalize both the disposal of and sale of fixed assets for both assets with no residual value and assets with residual value. Fixed assets reside on a company's balance sheet at historical value. In other words, original purchase price net of depreciation. So when does a company actually remove the asset from financials? Not until they are either disposed of or sold to another user. First, we will do examples where property is disposed of, and then we will do examples where property is sold. When looking at the disposal of property, I want to illustrate two different scenarios side by side. The first scenario we have office furniture with a $10,000 historical cost, and it's fully depreciated. In the second scenario, we will refer to the same office furniture, but it's not fully depreciated and is on the balance sheet with a net book value of $3,000. When the asset is fully depreciated, valued at zero, and thrown away, you simply just remove the accumulated depreciation from the books with a debit, because accumulated depreciation is a contra asset, and credit office furniture. However, if the asset is, like in scenario 2, has value, just the removal of those two accounts will not result in a balanced entry. An additional debit of $3,000 is needed to balance. The account debited is called loss on disposal of fixed assets. What happens is between the depreciation of $7,000 and loss of $3,000, the full purchase price of $10,000 ends up as a cost in the financials over the life of the asset. A key for both disposals and sales is that if a plug entry is needed to make the journal entry balance, using a debit or credit determines if there's a gain or loss. Thinking back to equity, revenue or gain is increased with a credit, and expenses and losses are increased with a debit. Expanding that to this discussion, if the plug needed as a credit, then the result is a gain. If the plug needed as a debit, then the result is a loss. If a company decides to instead sell their fixed assets, the journal entry is expanded. Let's again look at our two scenarios, comparing them side by side. And an additional fact is that the office furniture was sold for $500. In scenario 1, cash is debited for the receipt of $500. Again, both the accumulated depreciation on the books as well as the fixed asset historical costs are removed with a debit to accumulated depreciation of $10,000 and a credit to office furniture of $10,000. In order for this journal entry to balance, there needs to be an additional credit of $500. This credit is recorded to an account called gain on sale of fixed asset. If we assume this asset was again sold for $500, but using our second scenario for the asset, in other words, it is not fully depreciated, we again debit cash for $500, debit accumulated depreciation for $7,000, and credit office furniture for $10,000. This time, however, we need a debit of $2,500 to balance the journal entry. The debit is to loss on sale of fixed assets. Both the gain in scenario 1 and loss in scenario 2 are reported in the income statement. Actually, in both scenario 1 and 2, the impact on the income statement is exactly the same, they just have different timing. In the first case, depreciation expense of $10,000 impacts the earnings of the company, as well as the $500 gain. Net impact on earnings in this scenario is $9,500. In the second instance, depreciation expense to date was only $7,000, but the loss realized on the sale is $2,500, again resulting in a total cost of $9,500 to the company. U.S. GAAP accomplishes through these entries the same result, ensuring that financial statements reflect the full cost of an asset purchase over the use of the asset's life, less any funds received on resale, or in the case of a disposal, zero funds are assumed to be received. If my series on accounting basics has helped you gain a better foundation in accounting, please feel free to comment, share, and subscribe so you can receive updates when new videos are published.